Hello and welcome to this video on market efficiency. Very interesting and theoretical. It really gives a broad base to an understanding of a key concept of allocative efficiency. Very important in economic thinking. Now, let's first of all take a look at the price mechanism very quickly. Let's suppose that there's an increased demand for butter because people want to use it on their vegetables and pancakes when they're eating. Okay, so demand increases for butter. What happens in the market? What happens in the market, of course, we should know already is that there's going to be a higher price and there'll be more supply. There we have the butter market, and if we can see here an increase in demand, there'll be a shortage at first, and then up goes the price as more quantity is supplied. We know that. Really what's also happening here is that this is sending a signal to other producers. Hey, look at that, the prices for butter has gone up, and producers who are able to are going to start producing more butter. They will add more resources. In the long run, supply increases, and look at that, brings down the price again. Perhaps not all the way it was down before, but with that happening in the market, this is where prices can be stabilized over the long run and not increase so much just because of the dictates of demand. So this in itself shows how efficient markets are, that there's an automatic stabilizing because of the free ability for both producers and consumers to shift and make movement. What also happens is that producers who have a possibility of using the same materials to produce alternate products will decrease the supply in those in order to shift to more butter production, for example, for cheese. And if there's going to be not as much or any demand shift in cheese, but if more resources are taken away that could be used for cheese instead to produce for butter, there's less supply for cheese, and therefore we actually see the same sort of thing in the cheese market. Even though there's no change in demand, there's less supply, and that's going to drive up the price for cheese as well. Now, this also explains another interesting aspect, and that is derived demand. And that is milk being one of those resources or raw materials for producing both butter and cheese. And if there is an increased demand for the butter, then they need more milk to produce butter, and therefore the demand for milk will increase, and therefore the price of milk will increase as well. And that is the derived demand of a product, derived a resource market derived from the product market of butter that has been driving this demand. So that's all very interesting about how the market system works, which is good theoretical understanding about how to evaluate the market system. So in general, there are three functions being applied here. There's the rationing function to actually allow those who can afford the products to pay for them. As price increases, that rations out those who can afford them and those who can't. It's the incentive function is where the producers decide to shift their resources. So if there's going to be that shortage, then they're going to supply more and up goes the price. And the allocative device determines then where resources are actually going to be allocated in an economy. You may recall in the PPC model, there are alternative choices, but there's no way in that model to say what's best. Here is the model that says what's best. You allocate resources to where the price is higher, and that allows the resources to be allocated in an economy with nobody overseeing that process. So with that in mind, we now turn to the big question of allocative efficiency. And that is the method of how resources are best utilized in an economy. We're using a model called surplus theory, where we show that value, well, we call it welfare in the market, is maximized by the market participants. And if that's the case, we've got allocative efficiency. So, in a case of supply and demand, the consumer surplus is that extra satisfaction enjoyed for the consumers that they don't have to pay for because of the market price. So take a look at those consumers all the way up near the top of the demand curve at point A down to point E, or just before that. They're all willing to pay a higher price for this same product. But if the market determines it at the equilibrium price, then what we can see is that in this whole triangle here, there's an extra value being placed on the product that consumers enjoy without having paid for it. Similarly, producer surplus, the same concept. Extra revenue enjoyed by producers. Now I have to caution you, this is not a model showing profit as such. That is another model altogether. But what we're just saying here is that producers also are gaining for selling a product at the equilibrium price higher than that they'd be willing to take at lower quantities, and hence they too have an area of producer surplus, and together consumers and producers have a area of surplus that they enjoy. And that together, if it is at maximum, shows that there is allocative efficiency. If that producer and consumer surplus is at maximum, then we really have shown that the market is enjoying the best value for both consumers and producers together.